Imagine I handed you a map that supposedly led to a safe haven, but the map was written in a language that hasn't been used in 50 years. You'd probably ignore it. Most people are. Right now, the stock market is throwing the biggest party in human history. We are hitting all-time highs. Tech giants are promising us a future built on silicon and light. Everything looks perfect. But in the corner of the room, the most boring asset in history is doing something terrifying. Gold. The yellow metal your grandfather buried in the backyard is screaming. For 40 years, gold was the slow kid in the class. It averaged 5 or 6% a year. It was the insurance policy you hoped you'd never need. But over the last 5 years, gold hasn't been acting like insurance. It's been behaving like a tech startup on steroids, averaging nearly 20% a year. That is not normal. Gold doesn't just wake up after 4 decades of sleep and decide to sprint unless it sees something coming. It's behaving like it knows a secret that the rest of the market is too drunk on all-time highs to notice. In this video, we aren't just looking at gold prices. We're looking at the cracks in the global foundation. We're going to uncover why the world's central banks are suddenly hoarding metal like it's the end of days, why the US dollar is losing its God status, and the psychological reason why you might be looking at the wrong map. Welcome to Finance Conscious. Today, we're looking at the silent alarm. Let's go back to the basic psychology of safety. In the animal kingdom, when the birds suddenly go quiet, the tigers start to worry. In the financial world, gold is the bird. When it starts behaving erratically, it means the atmosphere is changing. For the last few decades, we lived in the dollar era. The US dollar was the world's undisputed heavyweight champion. If you wanted to trade oil, you used dollars. If you wanted to save money as a nation, you bought US treasuries. It was the ultimate trust exercise. The world gave America its goods, and America gave the world pieces of green paper. But trust is a fragile thing. It's like a marriage. It takes years to build and 10 seconds to set on fire. In the last 5 years, that trust has started to smoke. Why? Because we discovered that safe assets aren't always neutral. When the U.S. frozen Russian central bank assets following the invasion of Ukraine, every other country on Earth had a collective, "Wait, what?" moment. They realized that if their money is just an entry in a digital ledger controlled by someone else, it isn't really their money. It's a permission slip, and permissions can be revoked. Enter the central banks. While you were busy checking your crypto wallet or your Nvidia stocks, the people who actually run the world, the central banks of China, India, Turkey, and Poland, were doing something they haven't done at this scale in generations. They were buying gold. Not just a little, tons of it. In 2022 and 2023, central bank gold buying hit levels we haven't seen since the 1960s. These aren't retail traders on Reddit. These are the institutions that print the money. If they're trading their own paper for physical metal, what does that tell you about what they think that paper is worth? They're diversifying away from the US dollar at a record pace. This isn't a conspiracy theory, it's a math problem. If you hold billions in US debt and you see the US debt clock ticking past $34 trillion, you start to wonder when the I owe you becomes a you owe me. But here's where the psychology gets weird. Usually when gold goes up, stocks go down. It's the risk-off versus risk-on switch. When people are scared, they sell stocks and buy gold. When they're greedy, they sell gold and buy stocks. But right now, both are at all-time highs. This is the financial equivalent of a person laughing and crying at the same time. It's a sign of a split-brain market. One half of the market is betting on a soft landing and AI-driven utopia. The other half, the big money, the sovereign wealth money, is quietly building a bunker. Why? Because of the invisible tax. Inflation isn't just about the price of eggs, it's about the debasement of currency. If you have $10 and I print 10 more, your $10 just lost half its power. Over the last few years, the world has seen a literal explosion in the money supply. We printed more money in a few months during the pandemic than in the entire history of the United States prior. You can't do that without consequences. Gold knows this. Gold is the only asset that hasn't changed its supply much in 5,000 years. You can't print gold. You have to dig it out of the dirt at a massive cost. It is the ultimate no BS meter. When gold averages 20% a year, it's not that gold is getting more valuable. It's that the currency you're measuring it in is getting less valuable at a faster rate than you're being told. The psychological trap here is called normalcy bias. We think that because the dollar has been the king for our entire lives, it will be king forever. We think that because we can still buy a burger with a $10 bill today, the system is fine. But look at the timeline. The British pound was the world's reserve currency for over 100 years. People in the 1800s couldn't imagine a world where the pound was the center of the universe. Then the world changed. The Dutch guilder was the king before that. Every empire thinks its paper is special until the math proves otherwise. We are currently seeing a great diversification. Nations like China are selling U.S. treasuries and buying gold. Why? Because gold is nobody's liability. If I hold $1, I am depending on the U.S. government to keep its word. If I hold a bar of gold, I am depending on the laws of physics. In an era of geopolitical tension and massive debt, physics is starting to look like a better bet than politicians. Now, let's talk about the irony of the modern investor. We live in the most high-tech era in human history. We have high-frequency trading, decentralized finance, and AI-driven portfolios. Yet the most sophisticated players on the planet are reverting back to the most primitive technology, a shiny yellow rock. It's absurd, right? But finance is often about the Lindy effect, the idea that something that is longer survived is longer likely to survive in the future. Gold has survived the fall of Rome, the Black Death, 2 world wars, and the collapse of every fiat currency ever created. The Magnificent Seven stocks are great, but they've been around for 30 years. Gold has a 5,000-year track record. And what's happening right now is a psychological shift from growth to preservation. The fact that gold is behaving like a risk asset, going 20% a year, suggests that we are entering a period of front-running the collapse. People aren't buying gold because they want to get rich. They're buying gold because they're afraid of becoming poor. So what does this mean for you? If the birds have gone quiet and the tigers are nervous, what should you do? This isn't a call to sell everything and buy a gold mine. That's just as extreme as ignoring the signs. The lesson here is about finance consciousness. It's about realizing that the narrative you see on the news, the everything is fine, stocks only go up narrative, is only half the story. The other half of the story is being written in the vaults of the Chinese central bank and the Swiss warehouses. It's a story about the end of an era. The era of cheap money and unquestioned trust is closing. Gold is behaving like it knows the US dollar is entering its twilight years. It's behaving like it knows that the massive debt bubbles we've ignored for 40 years are finally reaching their breaking point. When an asset that is supposed to be boring starts doing 20% a year, it's not an opportunity, it's a warning. It's a warning that the normal we've known since the 1980s is an anomaly. The 5 to 6% returns were the steady state. The 20% returns are the emergency sirens. We're seeing a global game of musical chairs. The music is still playing, stocks are at all-time highs, but the big players are already hovering near the seats. They're grabbing the gold because when the music stops, you can't sit on a piece of paper. The US dollar isn't going to vanish tomorrow. You'll still use it to buy coffee next week, but its role as the anchor of the world is slipping. And when the anchor slips, the ship starts to drift. The question isn't whether gold is a good investment. The question is, why are the people who print the money so desperate to get rid of it in exchange for metal? If the architect of the building is running for the exit, would you stay inside because the lobby looks pretty? Most people will stay in the lobby. They'll wait until the exit is crowded and the prices have doubled again. They'll wait for the official news to tell them it's time to worry. But by then, the safety will be priced out of reach. This is the psychological trap you have to cross. Do you trust the all-time high party or do you trust the silent alarm? Gold is screaming, not because it wants to be a star, but because it's doing its job. It's reflecting the heat of a system that is running too hot for too long. If you've enjoyed this deep dive into the psychology of the silent alarm, you're exactly who we built this channel for. Most people want to be told what to buy to get rich quick. Here at Finance Conscious, we want to understand the why behind the what. We want to help you see the maps that the big players are actually using, not just the ones they show the public. If you want to stay finance conscious in an era of massive deception, hit that subscribe button. We're going to keep peeling back the layers of the global economy, from the vaults of central banks to the psychology of your own wallet. Because in a world where the birds have gone quiet, the only thing that will keep you safe is your own awareness. I'm Khan. Keep your eyes on the gold and don't let the music distract you from the exit. I'll see you in the next one.